The local stock market was not spared since the COVID pandemic swept global financial markets, losing 32%, slightly above the 5,300 barrier since the end of 2019. Fund outflows were visible for 27 index stocks led by GT Cap, Robinson's Land, and Bloom, while PLDT, Globe, and Pure Gold rose. Since the Philippine government implemented the Enhanced Community Quarantine or ECQ last March 17, businesses went on a standstill, prompting us to downgrade our economic outlook this year. From 2019's 5.9% GDP growth, we plotted out three scenarios based on the lifting of ECQ. If we look at the orange line, if the ECQ ends April, we're seeing flat growth with average GDP at positive 0.6%. Based on the red line, if the ECQ is extended till end May, we could probably already see negative GDP growth of 1.6%. And looking at the maroon line, if the ECQ is extended further till June, that would give us a negative 3%. Reverting to our positive 0.6% estimate, our assumptions are premised on the local economy's turn or return to normalcy, specifically for consumer and investment spending. The second catalyst is largely driven by reduced business costs due to monetary policy support, especially after the central bank lowered benchmark interest rates and reserve requirement. Meanwhile, challenges are still present as authorities secure an antidote to prevent the recurrence of the virus. Second, premised on the resumption of government projects, attention will be on how fast the rollout for infra initiatives for the remainder of the year, and lastly, on generation of higher tax receipts, with resources reallocated towards financial assistance during the ECQ implementation. Aggressive efforts were visible on the monetary side, with first quarter rate cuts paralleling 2019's total at 75 basis points. These run parallel to the lowering of the reserve requirement, with the first 200 basis points implemented end March of the year. With a tempered outlook on the local economy, earnings estimates for the year were adjusted. Based on this summary, the downgrade was heavy among holding firms and property. Meanwhile, sectors with minimal impact on earnings per share or EPS cover telco and retail. Plotting our adjusted earnings outlook to each sector's respective market capitalization, 2020 earnings may slip by 4.5% versus our earlier forecast of 13%. This is mainly driven by disruptions in business operations since ECQ was adopted last March 17. Valuation-wise, however, forward price to earnings or PE ratios are already at significant discount. As a whole, the market is already trading at 12 times forward PE, nearly half of 5-year PEs of only 20 times. Any mean reversion means investors could reap handsome returns. Having these, the best case of the market or PSEI is at 7.5 to 8,000 upon return of businesses to normalcy plus added monetary stimulus. Plotting 52-week lows of shares belonging to the index basket relative to our earnings expectations, we arrived at 3,700 to 4,000, implying the market may have already absorbed the COVID issue. For now, however, the market remains within a range of uncertainty at 4,100 to 5,700, and moving outside of this level is dependent on solutions to prevent COVID-19's recurrence. For our sector call, we think telcos, retail, and banking provide some sense of resiliency amid the pandemic. Our wild cards are on power and property, and we remain underweight on construction, gaming, and food and beverage. One of the few sectors that may benefit from the quarantine is telco, with homestay arrangements pushing use of data. As confirmed by Globe and Tel, data traffic growth in first quarter alone is seen at double digit, with possible even greater growth in second quarter. This leads us to upsize our EPS estimates for both companies, with Globe getting the higher upgrade due to its larger exposure to mobile data. The telco sector is a good dividend play with weighted yields seen at 6%. Potential upsides are also rewarding, coming from a base last year. Due to ECQ, discretionary retailing formats were required to close shop, but not grocery and other necessary retailers. And so, most of Pure Gold, RRHI, and Mrs. G's operations were not disturbed, unlike SSI, Wilkons, and some of Homes. In fact, we expect grocery revenues to get the boost from panic buying behavior in first quarter, which leads us to EPS upgrades in Pure Gold and RRHI. Note that between the two, Pure Gold should get the higher windfall since first, SNR is also reportedly operational under ECQ, and second, it doesn't carry discretionary heavy formats. For banking, we tempered lending growth expectations from 12 to 6% as banks turned cautious on borrowers' financial profile. Given the deferred collection of interest on loans, this table highlights EPS adjustment from positive 16% to positive 4.5%. Moreover, net interest margin or NIMS erosion will be visible given the drastic cuts in benchmark interest rates. Banks are likely to compete with the same prudent borrowers, which should bring about increased competition on yields. Meanwhile, higher provisioning is seen as banks reassess their borrowers' cash flow profile. Note, however, that coverage for non-performing loans or NPLs will remain sufficient post-COVID, given most banks moved to shore up their capital even before the ECQ started. With these, potential range is 24 to 84% based on revised target prices or TPs, and 37% to 56% discount based on historical price-to-book value basis. Moving on to power, the Energy Bureau is already eyeing 30% decline in total energy demand as businesses and factory operations went on a standstill. Luzon was impacted most, given its 73% share in the total basket. More specifically, utilities exposed to commercial and industrial segments were likewise affected, given these sectors' 52% share to total power consumption. This situation is best reflected how prices behaved at the wholesale electricity spot market or WESM with a clear downtrend. Lower WESM rates would affect merchant plants, especially those that have few covered contracts and sell their excess capacity through this channel. Given these, top-line estimates were revised. First Gen and AP should be insulated given the higher share of contracted capacity. Meanwhile, SCC may take a hit with about 30% sold via WESM. SCC would also need to contend with reduced coal prices due largely to reduced use. Meralco, meanwhile, could see 6% top-line cut based on industrial and commercial users' share. On the margin level, however, reduced fuel charges will provide a reprieve for the sector. From an average of about $60 per barrel, crude prices have declined to $20 per barrel due to COVID-19. From the right side of this chart, you would see fuel contributions to total cost per each listed energy stock. All told, EPS growth is seen to slow this year, ranging from negative 7% to positive 10%. Target prices were also adjusted, providing potential upside of 13 to 49%. For property, we calibrated our outlook per subsector categories. Under commercial, sharp catch-up in second half is seen despite the blanket waiver of almost 3 months' rent. Under office category, there was no reported blanket rent waiver at all, and ECQ rent were treated as deferrals. Also, note that BPOs were allowed to operate under the ECQ, being among the exempt sectors. Meanwhile, hospitality will take a hit as a result of domestic and international flight suspensions. This prompted us to reduce 2019's average occupancy of 80% to 0 to 35% this year. Some recovery may be seen in second half as soon as airport operations normalize. Lastly, we see residential side being affected most as project completions are extended, while take-up for new launches might slow as wallets are temporarily reallocated from real estate investment. That being said, here are property firms and their respective exposure to the previously mentioned risks. We highlight residential since most firms source revenues here, and so this may be a sore spot in earnings reports later on. And adjusting for all that, our EPS revisions are mostly negative. Note that the top two mall operators, Robinsons and SM Prime, which don't depend much on residential sales, have the least downgrades for 2020. These may be bargain plays, especially compared to current prices versus our net asset value or NAV targets. Meanwhile, we are underweight for construction, gaming, and F&B. For construction, no activities in March to April will hurt revenue recognition. Also, government's reallocation of earlier planned infra budgets towards financial assistance are likely to weigh on rollout. Within gaming, opportunities would arise once casinos reopen. Food and beverage, meanwhile, is a mixed bag, with staples getting some demand boost, while restaurants have zero top line outside of deliveries. Also, the liquor ban and higher excise taxes will hurt distillers and breweries. For stock picks, we are including TEL on the merits of improved data revenues. Aside from being a dividend play at 6.9% yield, the stock is trading at 9 times 2020 estimated EPS, a discount from its 18 times 5-year PE. Pure Gold remains a gold retail pick with outperformance in first half seen. Apart from undisrupted operations, positive surprises are expected once pent-up consumption returns. Metrobank provides a good value play, currently trading at 0.5 times price-to-book value versus 5-year average of 1.1 times. We also include First Gen trading at 59% discount versus 5-year average PE. RLC is seen to benefit from its defensive portfolio mix, and reversal of 2019's weakness is seen with about 1 billion pesos in earnings expected to flow from Chengdu project by second half of the year. AC presents upsides given the diversity of its portfolio. While it still needs to contend with its water concession issue with regulators, pluses are in place from its foray into energy. As a final message, we quote Robert Kennedy saying, "Only those who dare to fail greatly can ever achieve greatly." Given a challenging investing environment, it takes a good amount of patience to believe we can overcome, and a leap of faith, we emerge with deeper sense of courage in the recovery process. Thank you and happy trading.